Good evening, good afternoon, good morning, everyone. Welcome to session 2 of the 2020-2021 Sustainable Development Transformation Forum. My name is David O'Connor. I'm going to be moderating this session, which is on transformative partnerships for financing and investing in sustainable infrastructure, particularly in the energy and transport, but not only in those sectors. This is part of a broader theme for this year's forum on sustainable industrialization, sustainable low carbon green industrialization, in line with the spirit of the 9th Sustainable Development Goal. This session will focus on the financing and investment that needs to be mobilized in order to jumpstart or accelerate sustainable low carbon industrialization in so-called late industrializers, a term that has a long pedigree in economics. That is, countries which have not yet had sustained and dynamic growth of their industrial economies. The investments will span multiple sectors and multiple countries. They will also span multiple stages of the process of industrialization and multiple institutions needed to catalyze it. Some of the needed investments are likely to be largely public in nature, as with some infrastructure, for example, education. Others largely private, or at least primary education and lower levels of education. Others largely private, but partnerships of various sorts, including public-private partnerships, may be valuable in leveraging assets of multiple actors who bring their respective strengths and resources to the partnership. Today, we will hear from a distinguished group of experts covering different parts of the finance and investment value chain, and considering how finance and investment flows to infrastructure and industrial development in low and middle income countries can be augmented and, equally importantly, steered towards sustainable low carbon investments. So I'm going to introduce the speakers. I'll do it one by one, I think, because after introducing each speaker, I have a question to pose to him or her. I'll very quickly mention them by name and come back to their bios later. The first is Abad Alan. Well, actually, has he fixed his video yet? Will we start with Habard? I don't hear any reply.
He's out of the session currently, and he's trying to join back in.
Okay, so we won't start with Habard, but Habard will speak about institutional investment for climate-aligned development when he's available. Then we'll have David Horan, who will speak about multi-stakeholder partnerships and how to create and identify and create and curate those partnerships to support sustainable industrialization. Then Parasto Hamed, who will discuss the emerging phenomenon of results-based financing, or pay for results, in particular in regard to the agricultural sector of developing countries. And then we'll have a presentation by video by Daniel Platz of the UN on managing financial assets. So without further ado, perhaps we will start with David. David Horan is postdoctoral researcher at the School of Politics and International Relations at University College Dublin, and he will examine, as I said, the role of partnerships, public-private as well as multi-stakeholder, in securing and steering the investments and other resources needed to foster sustainable industrialization. So the question I posed to him, and he can answer in the course of his presentation if he chooses, is what are the distinct advantages of partnerships and where are they likely to contribute the most to sustainable infrastructure and industry in low and middle income countries. Excuse me. So David, Dr. Horan, you have the floor.
Thank you, David. So I'll just share because I have presentation slides. So just 1 second. Okay, so have I shared my screen there?
Yes.
Yeah, you can see the slides?
Yes.
Okay, perfect. Okay, thanks again, David, and I'm very grateful for the invitation to speak here today. Distinguished participants and guests, I'm delighted that you are here. Just to say before I start, I'm not an expert in international development, but I have done some work on partnerships, and I hope that it can be useful to you in your thinking about their role in transformations. So just to give a quick overview of my talk today, first I will start with some remarks about sustainable industrialization for low and middle income countries and the role that partnerships could play in that. Then I'll outline an approach to partnerships that could be well aligned with achieving a sustainable transformation. And finally, then to conclude, I will offer some recommendations on how that approach could be operationalized. So we know that industrialization, once it takes off, can happen quite quickly. For example, China and other Asian countries did it in just under 20 years. Now, in the rush to make it happen, one can easily overlook decisions made in the early stages that have long-term unsustainable consequences for your country for decades to come. And a prominent example of this is in the energy and transport sectors, which are key enablers for the rest of the economy. Now, I think it's really important to recognize at the outset that there are potentially enormous advantages to industrializing after others. So, for example, at least in principle, it is possible to leapfrog by adopting more sustainable technologies that have been developed in other countries. One can also avoid previous mistakes by adopting more sustainable modes of transport and thus locking in better social practices around that. One can also seek to adopt digital technologies to grow entirely new industries and use digital technologies to create more inclusive institutions and societies. The key question, I think, is how to make this happen. So I think we would all agree that partnerships have a key role to play in delivering sustainable transformations. However, that role is not clearly understood. And to answer your question, David, I think the main advantages of partnerships is their diversity, their flexibility, and their ability to mobilize. Now, when we think about how to industrialize, typically the emphasis is put on getting the policies right. So, for example, for a long time, that emphasis was on having a stable political system and macroeconomic environments and an environment that's attractive to business. More recently, a stronger emphasis is put on industrial policies, as was mentioned in the discussions yesterday. Now, while getting the policies right is undeniably important, underlying this, I think, often are partnerships that help to enable an effective policy environment. And that's in addition to the role that partnerships play in harnessing the other means of implementation, such as finance and technology. So I'd just like you to consider the case of Ireland and its economic transformation. The standard explanation gives a lot of attention to the mix of policies that made it happen. So, for example, a low corporation tax rate and access to a large European single market, in combination with investments in infrastructure and higher education, while at the same time a competitive advantage from relative low wages, and importantly also a peace agreement that ended hostilities in the north, all helped to attract investment and new technology. However, much less attention is given to the partnerships that I would argue actually enable those policies to be especially effective. So for example, connections with our large diaspora community in the USA were particularly important in bringing foreign direct investments into Ireland. Similarly, our EU membership was crucial to provide access to the single market. Also, a large portion of the funds to invest in infrastructure came from the EU Regional Development Fund. Similarly, a good portion of the investments in higher education expansion were sponsored by philanthropists, both in Ireland and in the USA, particularly for our high technology universities. In addition to that, prior to transformation, a social partnership between government and public sector workers helped considerably to ensure industrial peace following the strikes of the 80s, and also to tame wage growth that had contributed to cost-push inflation. Finally, it is inconceivable to think of a peace agreement without first an agreement between the communities to actually try and find peace that was helped hugely by the brokering skills of the American, British, and Irish governments. So basically what I'm trying to say here is that underlying Ireland's specific policy mix was a portfolio of partnerships that work together in a coherent way to create the conditions for economic transformation. And I think it is clear from the slide here that this portfolio consisted of a diverse mix of partnerships, public-private, multi-stakeholder partnerships that together combined to harness finance, capacity building, foreign direct investment and technology transfer, and ultimately making for an effective policy environment. Now, Ireland's transformation was not inclusive or sustainable. So to use a portfolio approach to achieve a sustainable industrialization in middle or low income countries, I think we need to really think carefully about what mix of partnerships might be needed. How can we have a portfolio of partnerships that creates the conditions for sustainable industrialization? In particular, what portfolio could help to bring in the technology and finance that helps the country to leapfrog and to avoid the mistakes that we have made in the industrialized world? So in this paper that I wrote titled A New Approach to Partnerships for SDG Transformations, I argue that it is helpful to think in terms of two portfolios. First, there is the current portfolio. These are all the partnerships that are currently in place operating within a country. Often we don't know what is in this portfolio, but I argue that it is potentially observable. So for example, most governments have a database of the development projects that it is managing in its country. Similarly, UN agencies have their own databases, also private companies. So in that sense, the current portfolio could be observed if we join together those different databases. The second portfolio is what I call here the target portfolio. It is the set of partnerships that could deliver a sustainable transformation. Now, however, it requires some work to know what that portfolio should actually be. But if we did know it, we could compare it to the current portfolio and ask ourselves, well, are there any missing partnerships? Who are the missing partners? And if there are gaps, how can we fill them? Does it require a policy framework and cooperation with UN agencies to catalyze and support the missing partnerships? Now, in the paper, and I stress again, it didn't look at international development, but it did try to probe some of the characteristics of a target portfolio for energy decarbonization in advanced economies. And for this, I used SDSN's decarbonization roadmap to 2050, And based on scattered examples of what I considered to be relevant partnerships, I identified some promising examples that should perhaps be in a transformation portfolio also for middle and low income countries. So just for now, ignore how these, I'm sure you're familiar with some of these different partnerships, just ignore how these partnerships actually worked internally. As some people have criticisms and valid in some cases of how they actually worked. But instead, just think about what they tried to achieve and where they might fit in a portfolio for transformative change. So in the paper, I outlined, just to get the ball rolling, 5 partnerships that together could help to initiate, smooth, and accelerate decarbonization. So taking the first example here, the Dutch Energy Agreement, it brought together stakeholders from government, the private sector, and civil society to envision a low-carbon pathway for decarbonization. And this type of partnership is particularly important at the outset for agenda setting and for getting buy-in from the various sectors of society. Now, the second partnership here is an example from America. The Transition Fund aimed to work with local coal mining communities to retrain and reskill workers for the green economy. And in a similar way, the third partnership, the German Coal Exit Commission, seemed particularly important also for gradual phasing out of coal in a cost-effective manner that could help to smooth the path to decarbonization. Now, these 3 partnerships are all national level partnerships involving local and national level organizations. And the last 2 partnerships, which focus on accelerating transformation, are all international in some of their participating partners. So firstly, the Nordic Transmission Grid is a partnership between 3 governments to share a cross-border transmission network to help address intermittency problems with renewables. The International Solar Alliance brings together leaders in advancing solar technology to try to lower the cost of technology and to transfer it. So these are just some examples of types of partnerships that might be particularly relevant to low or middle income countries. And if we take a leapfrogging perspective, other types of partnerships might also be particularly relevant. Now, as I mentioned, it's quite difficult to know what these partnerships should be. So I'm just being suggestive at this point, but some of these partnerships, working in a university context, some of these partnerships may be partnerships with universities in Asia and Europe to train African students to master and PhD level. And these may need to be rolled out on a larger scale than they currently are done. So that would be quite important for capacity building and technology transfer. Another example might be partnerships with international leaders in sustainability and technology companies to help these countries to adopt the better technologies so that they can enable leapfrogging. Now, that's just to be suggestive, to try and probe what the target portfolio might actually be. I think that would need to be done on a much more systematic and way, and in a much more on a much grander, a much larger scale. Now, the paper also did provide evidence to suggest that generally relying on these partnerships to emerge by themselves is a very hopeful approach, and that there are good reasons to believe that there will be missing partnerships, and that provides a role for governments and UN agencies to orchestrate partnerships. So my main recommendations are for each transformation, firstly, to construct the current portfolio of partnerships using data sharing agreements with UN agencies operating in your country and your own ministries to try and get a sense of what is the partnership landscape for implementing a particular transformation or addressing a particular sustainability challenge. And secondly, then, to use roadmaps to build a shared vision of the partnerships needed and identify missing partnerships. So roadmaps are quite useful in the sense that they can give you an idea of where partnerships might be needed and what function those partnerships should serve. And then finally, then to close the gaps, to invest in infrastructure for partnerships, partnership brokers, skilled professionals to represent partners in collaborations, and greater organizational capacity to engage in partnerships. And I think the overall aim should be to construct a country-specific yet diverse portfolio of partnerships involving local, national, regional, and international actors that is aligned to and capable of delivering a sustainable transformation. So just to conclude, if there's one thing I hope that you found useful in today's talk is that when thinking about transformations, a portfolio approach to partnerships could be very useful. A lot of our discussions at the UN tend to focus on best practice within individual partnerships and identifying successful examples and identifying in those which have difficulties what were the challenges. While that is very important, I think we also need to expand our discussions to thinking about coherent portfolios to deliver sustainable transformation. And in the example I gave there, it was just started out with a small set of partnerships, trying to think about what different stages in the process of transformation they might contribute to and what their functions could be in delivering that transformation. And I think road mapping is a useful tool for getting a better sense of what types of partnerships might be needed. And that to facilitate such a portfolio approach, we need a supportive infrastructure and policy framework to guide it. And finally then, because there's a lot of work to be done on this approach, practicing and sharing good practice should be a guiding principle for developing multi-level cooperation on transformative portfolios. So thanks for your attention and happy to hand it back to you there, David, again.
Thank you very much, David. The way we're going to proceed is that if anybody has any urgent questions you would like to pose to each speaker, then do it right now, in the case of David Horan. And then we'll have a round of questions for everybody at the end. So anybody want to raise any urgent questions for David, for Dr. Horan? So Louis Muhlmann, good morning, has this question for you, Dr. Horan. What do you do with existing partnerships or coalitions which are unsustainable?
Okay, thanks for the question, Louis. That's an interesting question. Yeah, that's. I think we need to. I think it's very important to take note of coalitions that often they're not easily observed, that are unsustainable, contributing to unsustainable development. I think we could take a few different strategies to deal with them. One approach could be to actually use economic compensation to decommission them, provided that's not too expensive on a country's resources. The benefit being of such an approach that obviously will be costly to decommission them, but the benefit being that, you know, if that coalition has captured policy, or if it's advancing technologies that, you know, really have no place in the long-term technology mix, then it could be worth our while decommissioning those. On the other hand, like thinking here of the fossil fuel sector, in some countries it can be really large, and in those cases, it's not economically feasible to decommission them, but You could look at other approaches like taking a sector by sector or regional approach where you support alternatives technologies to try and weaken the overall market power. So I think there's you have to look closely at the details of the situation. And I think a lot more work needs to be done. I don't think we've quite got to asking those questions yet. It's quite early on, I think, in developing a really coherent partnership approach.
Okay, thanks. One other question from the Philippines, I believe. Good morning, good evening, I guess it is there. What particular policies and partnerships do you think I have to, the thing is moving as I speak here. Somebody's got to help me here. What particular policies and partnerships do you think have been implemented in developing, sorry, I'm having difficulty reading this here. What particular policies and partnerships that have been implemented in developed countries do you think are relevant and suitable to developing countries like the Philippines to attain sustainable industrialization? I think you mentioned some of the cases of Ireland, but you also mentioned that Ireland's policies were not always sustainable. So try to see if you can address this particular question. Particular policies and partnerships that have been implemented in developed countries that are relevant to developing countries for sustainable industrialization.
Yeah, I think that's a great question too. So one of the interesting things when you think about partnerships is that, or at least in my own research, I often don't look to the developed world for the leading examples of things like platforms to enable partnerships. A lot of the most interesting work that's been done to advance partnership frameworks for sustainability is happening in countries like Kenya, Ghana. I was recently reading a report on from the African Center for Disease Control and the approach they took to manage the COVID-19. And I think there's leeway to really to experiment and to learn in any setting really, but I think some of these types of platforms give good examples of how you can construct a portfolio of partnerships that work together. So particularly in the case of the African CDC, they successfully managed to develop partnerships that brought in commodities and medical equipment, therapeutics and diagnostics that they were then able to transfer and distribute to the different regions, different countries within Africa. There's still we can still try a lot to improve those frameworks, but I think there are some of the really interesting examples happening at present.
Okay, thank you. Let me just see if there are any other burning questions. No? Okay, so we're going to move to the next speaker. And that will be Ms. Parasto Hamid, who works with Ag Results. And this is a pay for results initiative, prizes for innovations to farmers in developing countries. And she'll discuss how this works and what it has achieved, what have been the challenges, and how this is scalable or not. How does this compare, Ms. Hamid, sorry? How does this compare with the traditional approach to project-based donor finance? And as I asked just now, is it a model which can be successfully scaled to achieve large-scale impacts? So you have the floor, please, Ms. Hamid.
Prior to speaking, can you hear me well?
Yes. Try again.
Is this better?
You're too soft at the moment, I'm afraid.
We had this
There,
problem.
there.
I
Okay,
think.
okay, go, go, go.
All right. Give me one moment to share my screen. Okay, well, thank you very much, David, and distinguished guest participants. Now I'll be speaking about the Ag Results Pay for Results initiative, looking at leveraging pay for results incentives to drive transformative partnerships in the agriculture sector.
Just 1 second, Parasto. I think that your presentation has been substituted by your screensaver. So can you try to get back to your presentation?
All right, let's stop screen sharing one moment. Okay.
Okay, good.
There we go. So yes, Ag Results is a $152 million pay for results initiative that looks at incentivizing the private sector to invest in high impact agricultural innovations that help achieve the following goals: reduce food insecurity, improve household nutrition and health, and increase livestock productivity. Ag Results' theory of change rests on the idea that if appropriately incentivized, the private sector will respond by creating and/or scaling new technologies that benefit smallholder farmers. Ag Results has had a total of 10 projects, 4 of which that have been completed and 6 that are currently implemented. And these projects are global and take place across the world. Why the Ag Results prize competition, as you asked? Prize competitions offer a unique value added to traditional push grant funding. It provides the private sector with the opportunity to educate, inspire, and mobilize neglected issues. It also really offers the opportunity to only make payments when achievements are accomplished and there are outcomes. Solution agnostic, these projects are also solution agnostic and allow the private sector to respond in ways best suited to their business models. And finally, it allows for experimentation, multiple solutions, and varied paths to success. The prize competition encourages new partnerships that drive scale up and transform systems to make them more sustainable and resilient. So the Ag Results competitions use monetary incentives to engage the private sector competitors and encourage new relationships along the value chain. These partnerships establish innovative behaviors that have potential to be scaled and sustained, transforming the entire market system. Prizes motivate private sector competitors to venture into untapped markets and adopt new ways to solve existing problems. Also, prize-driven actions encourage competitors to adapt current business models and create new partnerships. As economic benefits of these partnerships emerge, the broader market landscape shifts and expands to further strengthen relationships and access to solutions. Over time, mutually beneficial partnerships along the value chain position competitors to better respond to challenging market demands, transforming the entire market system, where you are really able to see sustainability, resilience, and scale take place. Now I'd like to take a closer look at 2 different Ag Results projects that have taken place. The first one is the Kenya On-Farm Storage Challenge project. Eastern Africa suffers from post-harvest grain losses that cost about $1.6 billion annually. But smallholder farmers cannot access on-farm storage technologies and are forced to either sell their crops immediately after harvest or use insecticides and less effective storage methods. To address this problem, Ag Results implemented a $12 million prize competition that incentivized private sector companies to really develop, market, and sell on-farm storage hermetic devices to smallholder farmers in the Kenya's Rift Valley and Eastern region to overcome storage challenges and to reduce post-harvest loss. The prize structure was developed to motivate competitors to sell a minimum amount of storage capacity. That amount is 21,000 metric tons to smallholder farmers. This prize was designed in 2 phases. There was a midpoint prize of $750,000 for each competitor that reached the minimum 21,000 metric ton storage capacity threshold. Then at the end of the competition, there was an end of project prize of $1 million and $3 million, depending on the region of sale, which incentivized a greater amount of storage higher than the minimum threshold that we had set. At the end of the project, what we really saw was smallholder farmers were able to increase their use of hermetic devices to reduce their post-harvest grain loss. In Kenya, the prize for on-farm storage devices for sales to smallholder farmers really encouraged companies to rethink their outreach and their distribution approach. Smallholder farmers were not normally their buyers, so they had to really look at how they can adjust their business model to strengthen their partnerships with wholesalers, retailers, and farmers groups to bolster their entire market system. The Kenya Prize competition was able to use monetary awards to motivate companies to develop innovative distribution channels to better access and sell their storage devices to farmers. These monetary nudges motivated competitors to reach previously inaccessible farmers and encourage them to identify innovative ways to reach rural areas and populations. Formal investments into marketing, distribution, to really be able to get on-farm storage technologies to remote end users drove change in competitors' business models to prioritize different partnerships. And more efficient and mutual beneficial partnerships among the private sector, wholesalers, retailers, and farmer groups strengthen the entire value chain. Kenya's agriculture sector is positioned to expand smallholder farmers' access to key storage technologies and respond to post-harvest loss. Next, I'll be looking at the Nigeria Aflasafe project. In Nigeria, the high prevalence of aflatoxins in maize produces a toxin that is carcinogenic and is associated to childhood stunting. To address this problem, AgResults provided a $12.6 million prize competition that incentivized the private sector aggregators and grain traders to work with smallholder farmers to adopt Aflasafe and improve high-quality maize. To achieve this, competitors worked with farmers, providing them with value-added services, such as access to and training of Aflasafe, as well as other inputs that would increase production and yields. And they worked with these farmers to increase market linkages. Competitors received a premium payment of $18.75 per metric ton of aggregated maize that had a 70% or greater prevalence of Aflasafe. Smallholder farmers benefited from higher yields, linkages to premium markets for aflatoxin-reduced maize, and consumption of aflatoxin-reduced maize. In Nigeria, prizes for aggregated maize treated with Aflasafe encourage companies to teach best practices in the use of Aflasafe application to smallholder farmers while raising public awareness of health benefits, creating partner-based approach to drive up market demand and market prices for a higher quality product. The Nigeria Prize competition was able to use monetary awards to show the private sector the potential economic benefits of delivering a biocontrol agent to smallholder farmers. These monetary incentives motivated competitors to test out a nascent product and prove its efficacy among smallholder farmers through demonstrations and extension services. As companies built initial trust and credibility, they coordinated to formalize delivery and technical assistance to smallholder farmers, driving up changes in their business models while delivering a range of key inputs. Aggregators develop partnerships along the maize value chain with input providers, processors, extension agents to create value added and increase market demand for higher quality maize, bringing farmers into a formalized premium market. With an interconnected value chain high demand for a premium product, the maize sector was better poised for continued growth, making an entire market system more resilient and sustainable. Finally, as ag results prize competition models use monetary incentives to enable private sector competitors to overcome financial and logistic challenges impeding sustainable market growth. The competitors are able to incentivize to establish critical partnerships along the value chain to better deliver solutions to smallholder farmers. As we saw in Kenya, competitors were able to create partnerships to build out distribution channels and reach previously inaccessible smallholder farmers. In Nigeria, competitors were able to partner on value-added activities such as input delivery and extension services to drive up market demand and prices. In both cases, mutually beneficial partnerships increased access, trust, and delivery of technological solutions, strengthening market systems so that there is a more sustainable, inclusive, and resilient system. Thank you.
Okay, thank you very much, Ms. Hamed. I think there are some questions already, but again, seeing them may be a little bit tricky here. Let me try to see what I can do. Okay. Right. Okay. So first question from an unnamed participant is regarding aflatoxin. Just wondering if use of, I think the person meant Alpha-Safe maize as opposed to aflatoxin maize, created any kind of dependency among farmers once project finished and did not push the farmers back to high toxin maize.
The objective of the project wasn't to only have Aflasafe provided during the project. Our initiative and our goal was that we would work with our aggregators that work directly with the smallholder farmers to make smallholder farmers aware of Aflasafe as an input that could be used and see the benefits of the use of Aflasafe to reduce aflatoxins. The objective was to create awareness, increase adoption of Aflasafe, and then as the project closed out, those aggregators that were working with the smallholder farmers would continue to provide and sell Aflasafe to farmers so that it wasn't that Aflasafe was no longer used after the project. We were working to create a sustainable market and sustainable adoption of this input so that aflatoxin reduction would continue well after the project ended.
Okay, thanks. Seems like we have another question. No, just okay, here we go. From Sophie Morgan. Is the competition open to innovators in the country where the problem exists? Only, I guess she means, or is it free to enter from any country? So could some competitor from a country other than Nigeria enter a competition that's serving Nigeria? I guess that's the question, if I'm not mistaken.
Yes. Of course, we can have competitors and private sector entities that do not work in the country. We saw that in Kenya. We did actually have a number of non-Kenyan companies that were registered in country but based outside of the country that participated. We didn't see it so much in Nigeria just based on the nature of the project where the competitors had to have relationships and direct access, but it would never disqualify a private sector entity to participate in a competition.
Okay, and she's got a follow-up question. After the solution has been provided to the problem, so storage in one case and Aflasafe in the other, on-farm storage, that is, what kind of follow-up support is provided to the problem group to ensure any maintenance skills to use the solution is enabled within the community?
So for Aflasafe, as it's a biocontrol agent that many of the farmers are not aware of and are not familiar with in most cases, there was a lot of extension services. There was a lot of support provided by the private sector. The idea of ag results being solution agnostic works in the benefit of the private sector to see how they can sustainably provide or sell inputs to farmers that provides them with a benefit, recovering their costs, seeing a profit, so that it is a continued approach that they will have after the project ends. The idea is that we provide incentives upon results so that those relationships are created and it is sustainable after the incentives are taken away. So the idea is that these relationships that were created throughout the project would continue after the project, and our competitors or private sector entities would know the smallholder farmers that they've worked with and will continue to reach out to them and provide them with the services after the fact. The incentives don't identify or select any farmers or push any work onto the private sector. It's really on their own accord how they want to work and create a sustainable market for themselves.
Okay, good. So I have one last question for you. I noticed that the sponsors of this Ag Results Initiative are all public development cooperation agencies of one kind or another. And I guess the question is whether that model itself is sustainable in terms of ensuring continuity of finance. Development partners sometimes are driven by fads and move on to new things. Is there any incentive for private enterprises to fund such prize initiatives themselves? I mean, obviously you're targeting smaller local enterprises with the prizes in some cases, so they wouldn't have the resources themselves necessarily to fund this. But are there other, possible sources of private finance that could make this initiative perhaps more sustainable and even scalable?
Private finance. So the objective of the Ag Results project with the government donors is to have a complementary project and type of initiative that works alongside the push grant funding. I have seen private institutions such as the X Prize and others that use the pay for results model outside of agriculture to be able to move initiatives forward. So there are other private donors. With Ag Results, we haven't seen the fact that their government agencies really be something that would benefit or deter from the impact of the project. I think the way our donors look at it is it's a different type of mechanism in their toolbox that can be used to really push development initiatives forward to a more sustainable market, bringing in the private sector to create these market linkages to continue on and make this a sustainable initiative and build off of that. So I don't think donor funding matters as much.
Right. Okay. Well, thank you very much. That was very fascinating. It does remind us. Yeah, Colm Foy has something to add here. Colm?
Yeah, I just was wondering, in the Kenya case, if my memory serves me well, you were supporting hermetic storage, including fixed bags and others. Do you do quality control of the innovations that you are supporting? Because in the Kenya case, for example, one particular form of hermetic storage was vastly superior to the competitors, but I'm not sure that Ag Results actually differentiated. Could you enlighten us on that?
Yes, so to answer your question, specifically with the Kenya project, We did conduct our own testing of the devices to be able to determine whether or not the devices being sold were actually hermetic. We did not have the ability, and we worked with the Kenya Bureau of Standards to determine if there was a quality testing within the country, and they at that time did not. So iResults conducted its own quality testing of the devices being sold to ensure that we were incentivizing a quality product and not just say, we've done that across all of our projects in if there was a quality concern of the input or the technology that we were supporting to ensure that we could confirm that it was a quality product.
Okay, so we still haven't been able to reconnect with our OECD speaker, it seems. Is that the case? Perhaps, Colm, you could send him a quick email or some message to see if he's able to reconnect. And meanwhile, we'll go to the video of Daniel Platz. Could you help with that, Colm? Thanks. So we have a video now about managing infrastructure assets in developing countries. Do we have sound with this or not? I don't hear any sound, but maybe it's coming.
Hello, everyone. Thank you for the opportunity to present at today's Sustainable Development Transformation Forum. Thank you to Jean for inviting me. Thank you to all distinguished fellow panelists. Thank you to David for moderating this session. Today, I would like to present our activities in the Department of Economic and Social Affairs on infrastructure asset management. That project is a joint endeavor between UNDESA and the United Nations Capital Development Fund. In particular, I'd like to present to you the new UN Handbook on Infrastructure Asset Management for Sustainable Development. But let us spend a few seconds on the actual meaning of infrastructure asset management. Well, what is an infrastructure asset? Here we talk about infrastructure assets in the context of all physical assets that are essential to the delivery of basic public services. They include traditional infrastructure facilities like roads and water, and sanitation systems, electricity grids, the land that roads are built on, the buildings that house essential services like schools and health facilities, and the equipment and information technology systems needed to operate and maintain those infrastructure facilities. Why does infrastructure asset management matter for the SDGs? Well, resilient infrastructure and the systems that support it are needed to achieve 92% of the SDGs and their targets. This is the result of a study done by one of our implementing partners, UNOPS, and the University of Oxford. Underinvestment in infrastructure maintenance costs some developing countries up to 2% of growth in GDP, according to World Bank studies. And here's a very striking number. The actual construction or acquisition cost of an infrastructure asset typically only accounts for 15 to 30% of overall expenditures, compared with the 70 to 85% of the cost of an asset that is incurred after it is bought or built. The handbook then is really the result of field work. In the context of a development account project within UNDESA, capacity development activities on infrastructure asset management began in 2017 on 4 pilot countries: Bangladesh, Nepal, Tanzania, and Uganda. In these 4 pilot countries, we did scoping missions, technical assistance workshops, diagnostic assessments, training of trainers, and on-site support for the implementation of asset management tools. That remains active to this day. The handbook, as I said, is a comprehensive toolkit of practical knowledge. It is very much accessible, and it includes many examples from the real world that we collected in consultations with a wide and diverse range of stakeholders that contributed to this. The contents are based around 4 parts: readers' tools, fundamentals, in focus chapters, and annexes. The crucial parts are really part 2 and part 3. Part 2 gives the reader an introduction into asset management and a tour through our tools with very practical exercises and examples on how to apply those tools. Part 3, the in focus chapter, talks about capturing and utilizing the right data and information, improving climate resilience, strengthening public health emergency preparedness and response, and establishing and sustaining a national enabling environment. Here, just a few images to give you a flavor of the visual structure of the handbook. You can see that we're really trying to simplify things and focus on the very fundamental questions of asset management, best captured as the 6 whats of asset management. What and where is the asset? What is it worth? What is the condition? What is its remaining service life? What is its deferred maintenance, meaning what type of asset management actions have been delayed or are still to be implemented and are urgently to be implemented in many cases? And what should you fix first? Those 6 whats are crucial questions that we usually ask asset managers at the very beginning of our workshops. Here, a few charts and visuals and graphs related to our field-tested tools. The diagnostic tool provides asset managers with a very detailed assessment of their asset management needs, with results and with targets that can be reached through certain policy intervention. Figure 1 here shows you the Asset Management Action Plan, which is a process of consecutive steps that allow asset managers to identify critical asset, set performance goals, assess what actions need to be taken to actually reach that performance goal, and then design and ultimately implement concrete plan of asset management actions for a priority asset. These are just some visuals from our data chapter, our climate risk assessment tool in the climate chapter, our health emergency toolkit, and the chapter 8 on an enabling environment. As I mentioned earlier, the preparations of the handbook are based on more than 30 rounds of consultations with experts and practitioners in the areas of asset management, climate resilience, disaster risk reduction, urban development, and many more disciplines that are important for asset management. That list is growing and includes critical stakeholders like the Asian Development Bank, UNOPS, Cities Alliance, UNDP, African Development Bank, and think tanks like the Overseas Development Institute. Here, we also mention OSDs and MOOC. OSD stands for Online Solutions Dialogues, and the MOOC stands for a massive open online course. Online Solutions Dialogues are ongoing, and these are really workshops on the handbook that we're implementing right now in Latin America and the Caribbean, Asia and the Pacific, as well as Africa. The MOOC, the Massive Open Online Course, is a self-paced asynchronous course based on the handbook that is now being developed together with Columbia University and UNI, United Nations Institute for Training and Research. Here, a little slide on the Online Solutions Dialogues. So far, we've seen great interest. The first 2 workshops have attracted over 800 participants from Africa, Latin America, and the Caribbean. Despite the large number of participants, we're trying to keep it as interactive as possible through many tools like Mentimeter and polling and breakout rooms. And so we're learning as we're going along. But of course, if you're aiming to cooperate with local governments, you need to be sure to include as many as you can. There are many local governments out there, and hence the idea really to do both an interactive workshop, but also a large workshop that allows many local governments from across the world to participate. Here are just a few slides on the massive open course. And here our new homepage on infrastructure asset management, where you can learn more about our activities and where governments can request technical assistance if they wish to work in this area. What are our planned capacity development activities for 2021 and beyond? Well, we have a training of trainers planned to central government officials in the application of asset management tools. We will expand our target countries based on demand in 3 regions. We'll continue to provide field support to local governments in the implementation of asset management action plans. And we will do workshops targeting ministries of finance and ministries of local government on building and enabling regulatory policy and legislative environment for asset management. As I mentioned earlier, we're also looking to enhance impact scale and sustainability of project activities through strategic partnerships within and outside the UN system. Partners will include UNCDF, UNEP, UNDP, GIZ, regional development banks, and many more. Here are some contacts and links for you to find out a little bit more about our work. My name again, Stanley Plutz. Please feel free to email me directly or email the address to the address IAMH@un.org. That stands for Infrastructure Asset Management Handbook. The handbook is available. Right now it's available in English. It will be available in all 6 UN languages, as well as some local languages like Nepali, Bangla, Swahili, and other languages like Serbian. Online solutions dialogues are ongoing. I encourage you to sign up for them. They're free and result in certification that allows local government to apply to municipal investment funding, especially in the context of UNCDF's Municipal Investment Fund, and also qualifies participants to receive further technical assistance from the UN system. The IAM homepage, again, is still in construction, but very informative already. And here's the link for that page. Thank you again for your time. I'm sorry I went a bit over 10 minutes. I hope you have a wonderful rest of the session, a wonderful rest of the forum. And I hope to see you again in person after COVID-19 is over, or at least under control. Stay safe, stay well. Thank you.
Okay, well, thank you for that, Daniel. Unfortunately, Daniel is not available to answer questions, but I sent a question to the participants. If any of you is an asset manager and has any observations, perhaps some of you have used this tool or have some specific observations to make on Daniel's presentation, feel free to do so in the chat room. Excuse me. Meanwhile, let me ask our technical support people if Abbas is on the phone now and available to give his presentation, and if we have the PowerPoint. Could somebody let me know if that's the case? Great. Okay. So let me quickly just introduce the presenter. I don't want to take time. I don't want to lose his connection. So this is Abad Aland, senior economist at the OECD Development Center, excuse me, who will be speaking about mobilizing institutional investor capital for climate-aligned development. And I won't go through in detail what he's going to say, because he'll say that, but he's going to focus on multilateral development banks and why or why not have they been able to tap into the huge pools of institutional investor capital to support infrastructure, sustainable infrastructure, and industrial development in the developing world. So, Mr. Alan, Dr. Alan, you have the floor, please. Is he there? Hello? Can't hear you. Anybody able to see if we can get him? He said he was connecting by phone, and I'm not sure what the problem is. Okay.
They did.
Yes.
We do have a question from a participant, Abdur Chima.
Okay, go ahead. I'm trying to deal with this next presentation, so go ahead, Colm.
I'm just
Oh,
thinking
Havard, excuse me. For the technical people, Havard is saying you need to unmute him in order for him to speak. Can you please unmute him? Can somebody get the message to the technical support to unmute the next speaker?
he is unmuted.
Okay, so can you hear me now?
Okay, thank you.
To the
Yes, we can
technical
hear you.
people- Excellent. So to the technical people, if they want, they can put me on camera as well. So there. All right. So can you see me and hear me?
We can both.
Okay, excellent. Well, my computer chose the perfect time to crash, of course. So I'm connecting via my phone. We'll see how that goes. So thanks for having me. I will, as was said, I will talk about the mobilization of institutional capital for climate-aligned development, and I'll focus on the role of multilateral finance institutions. But a little bit of background first. According to the OECD Global Outlook on Financing for Sustainable Development for this year, global financial assets are at their highest now since before the financial crisis at $379 trillion, of which, if we can change the slides, of which 81%, next slide, please, of which 81% is held in advanced economies, 15% in China, and only 4% of is held in ODA eligible countries and in countries that receive development assistance. So a big challenge is, of course, to get more of the money of the capital from the blue to the dark blue. And then next slide, please. There is the number that I would like to talk about today, which is 0.4, which is 0.04, which is what you get if you divide the total annual official development assistance by the value of the assets of total global financial assets, and you get 0.08 if you divide it by the assets held by institutional investors, which is about half of total global financial assets. Next slide, please. So as we know, multilateral finance institutions have made great efforts to mobilize private capital. In 2019, multilateral development banks and development finance institutions mobilized $64 billion of private finance, which gives us a multiplier of about 0.4. So for every dollar that was deployed as development finance, 40 cents were mobilized from private investors. Now, this may actually be an overestimation, since much of it comes from impact investors and was already available for development finance. So it's not necessarily additional. It's been redeployed from other forms of development finance. So this means that we are still far away from covering the Sdg financing gap. Next slide, please. Which the OECD Global Outlook estimates to have grown from 2.5 trillion to 4.2 trillion during the COVID crisis. Now that consists of an estimated $1 trillion of additional needs for COVID spending and 700 billion drop in external private resources in 2020. So this is actually a drop that is 60% larger than the drop after the global financial crisis. So according to the Global Outlook, reallocating just about 2% of the total assets held by institutional investors, which amounts to 4.2 trillion, would be sufficient to fill the gap in SDG financing. However, very little capital from institutional investors goes into development finance, and then we're referring to pension funds, insurance companies, and sovereign wealth funds. Efforts have been made. Development finance institutions have increased their share of equity finance over the last few years. Multilateral development banks have strengthened their offers of risk mitigation products, as well as their efforts to support legal and regulatory reform of financial and energy markets. So this is all well and good, but it has not been successful in mobilizing capital from institutional investors. And there is actually very little engagement between multilateral finance institutions and institutional investors. So we argue in this paper that to attract the interest of institutional investors, multilateral finance institutions must begin looking to large institutional investors as their partners and their clients. So this is the main thing that I would like us to take away from today's from this paper. And multilaterals must also go from focusing on financial instruments to focusing more on governance and institutional aspects within the multilaterals themselves. And I'll get back to what we are referring to. So let's next slide, please. Let's look at a couple of the key relationships that we think that multilaterals need to pay more attention to. There is the relationship between development finance providers and institutional investors. And then there is a second relationship, which we think is also very important, between local strategic investors and development finance providers. So over the last decade, we've seen the emergence of strategic investment funds and green banks. About 20 countries have established strategic investment funds, and a number of others have established green banks. So these are institutions that focus on infrastructure. They have a double bottom line of financial and development returns, and they have the specific purpose. They're set up with a specific purpose of mobilizing private capital. So the reason that we're interested in these green banks and strategic investment funds is that they appear to have been quite efficient at mobilizing private capital. So if we look at some numbers at the next slide, please. If we look at green banks first, we see that multiplier effects range from 1.8 to 10. So about $1.8 to $10 of private co-investment for every dollar of public capital that has been deployed. So if we next slide look at the multipliers for strategic investment funds, there is a range of multipliers. The Ireland's fund has a multiplier of around 2.5. The EU's Marguerite Fund and Senegal's FONSIS have multipliers of about 10. Next slide, please. So we have not estimated multipliers for individual multilateral finance institutions. Instead, we have used the multilateral climate funds as a proxy for multilateral finance institutions. And here the picture is quite different from green banks and strategic investment funds. Multilateral climate funds can have multipliers as high as 6 or 7, but most of this capital comes from other public investors. So if we use the ratio of private to public capital, you have multipliers that are around 0.3 or 0.4. So for every dollar of public capital deployed, there's only 30 or 40 cents of private capital that's co-invested. So why is this? Well, let's compare some salient features of green banks and strategic investment funds with the features of multilateral climate funds. Successful green banks and strategic investment funds have governance structures that are similar to private sector institutions. They have a high level of representation of independent directors on their boards and investment committees. They source their projects from a wide variety of sources, from developers, from partners, from government. These are independent and professionalized investment organizations, and they recruit their staff from the private sector. Now, for multilateral climate funds, board composition emphasizes country representation. So it's very different. Board members may not have financial sector background. They come from the Ministry of Development or Foreign Affairs, or from the Ministry of Finance of the member countries. There are no independent directors on the boards appointed for their sector expertise. There are no investment committees with majority representation by independent directors. So these are very different. These are very different structures. Furthermore, green banks and strategic investment funds have the boots on the ground. So they're staffed by locally connected professionals, frequently people from the diaspora that have returned to the home country with experience from global financial centers. They have local networks in government and in the private sector, and they're in a position to follow up projects day to day and help foreign investors mitigate risk. So next slide, please. So let's pause now to the next topic of the collaborative platforms of institutional investors. So the link with institutional investors again, and I'll explain why this is important for development finance in a minute. Next slide, please. So institutional investors are increasingly joining forces on collaborative platforms. And there are several advantages to this. So they can take advantage of the local knowledge of partners in each country. They can pool resources for due diligence and research and monitoring. They can get deal flow from partners, and they can increase their opportunities for diversification. And the local partner, a strategic investment fund, if it is, can mitigate headline risk and political risk. So another reason that collaborative platforms are established is that some institutional investors seek to reduce dependence on financial intermediaries and bring investment management in-house. And these institutional investors consider that outsourcing to external managers is expensive, high fees, and it's hard to design good incentives for long-term investment. Even if you know that there is a significant liquidity premium for infrastructure, external investment managers still tend to be assessed on quarterly results, so that outsourcing inserts a short-term bias into the investment process. Now, as disintermediation reduces short-term bias, it also eliminates a bottleneck between two categories of long-term investors: institutional investors on the one hand, and multilateral finance institutions on the other hand. So this is where we think there are some opportunities. So collaborative platforms offer an opportunity for multilateral finance institutions to engage directly with institutional investors. However, as of now, collaborative platforms have nearly no presence of development finance providers. There's one platform where the EIB, the European Investment Bank, is a founding member, the Long-Term Investors Club. But in this case, the other members are mostly public financial institutions as well. So next slide, please. So what are the potential implications for institutional investors? If we go back to the relationship between multilateral finance institutions and local strategic investors, multilateral finance institutions could convert their debt offering to long-term equity, either through direct capitalization of strategic investment funds or through loans to the home governments of strategic investment funds, or they could co-invest at the project level as well. So by rewarding the best performing strategic investment funds, multilateral finance institutions could promote competition and reward performance. So the thing is, we're starting to get the picture here that the argument is multilateral finance institutions could mobilize capital on collaborative platforms that institutional investors already use, and work with local strategic investors to connect locally. Well, not quite. It's a bit more complicated because we talked to institutional investors as we wrote these papers, and a number of them, and we found they're not necessarily eager to work with multilateral finance institutions. There is a concern that projects pitched to them by multilateral finance institutions will be sub-commercial, or that they will be high risk, or that if something goes wrong with a project, a development finance institution may not react as a commercial investor. So overall, institutional investors tend to be quite wary of double bottom lines. So what we argue in our paper is not only that multilateral finance institutions need to engage on collaborative platforms and with local strategic investors, but that to do so, they may also need to change. They need to continue to function within a policy-defined mandate, but within that mandate, they may need to become more like private investment organizations. Multilateral finance institutions may need to become more like the most efficient green banks and strategic investment funds. That's our argument. They may need to bring their governance more into line with private sector organizations. Multilateral finance institutions tend to be quite risk averse. They need to find ways to address this risk aversion, and they may need to strengthen their capacity to assess and manage risk on commercial terms, and as well as to source projects more broadly and not only from governments. Next slide, please. And so back to the point that I was making initially, to engage institutional investors, multilateral finance institutions need to engage on terms that are interesting to these investors. So the proper question for a senior executive of a multilateral finance institution to ask his corollary senior executive of an institutional investor organization is, what keeps you up at night? How can I help you mitigate the risk that you are facing? If we work together to mitigate risk, which new geographies and sectors do you think that we could move into together? So multilateral finance institutions need to be able to add value for institutional investors. They need to be able to provide institutional investors with the confidence that blended finance investments are commercial and that they can assist institutional investors with assessing risks in new sectors and geographies. And finally, we think that a blanket approach to blended finance may be counterproductive. So some geographies and regions will always be the remit of public finance. The risk is too high for institutional investors, certainly, and in some cases for private capital overall. So multilateral finance institutions should focus on mobilizing capital from institutional investors in contexts where commercial private investment is likely to be feasible and where the scale is sufficient for institutional investors, which is another issue. That there tends to be the capital that is coming from impact investors mobilized, that is currently mobilized, is generally going into relatively medium and small size or small scale projects. So this is our argument. We do think that there has to be a change if there is to be mobilization of capital from this category of investors, from institutional investors. We do think that these investors need to be treated as partners, as clients, by multilateral development finance institutions, and it's a competitive market, so they have to compete with other asset managers. So without the mobilization of capital from institutional investors, it will be very hard to achieve the sustainable development goals. And the billions to trillions argument, which was advanced a number of years ago, it hasn't really turned into trillions yet. So the current strategies for private capital mobilization are not working at the necessary scale. So we think it's time to think anew. Thank you.
Thank you very much, Abad, for that fascinating presentation. It's also very sobering at the end there, because it seems that basically we're in a bind. If indeed it takes the mobilization of institutional investor capital to, bridge from billions to trillions to achieve the SDGs, and we're very far from being able to do that at this point in time, it seems, from your presentation. One question I have, and please, I think there are some questions here from others as well, which I'll come to in a second, but one question I have regarding governance structures. You talked about how these strategic investment funds and green banks have more like a private sector governance structure than MFIs. Um, and I was wondering, is there any reason for possibly bifurcating the governance structure of MFIs, creating a spin-off of some sort, or dual structures? You have a dual bottom line you talked about, and the institutional investors aren't happy with that. So maybe, to attract the institutional investor capital to these platforms, to work with the MFIs to get more private finance into developing countries, you need to think about a governance structure which addresses the risk concerns of those investors, whereas you have the concerns of the public sector providers of capital to the MFIs, that they want the double bottom line and they're not so concerned about the commercial risks and the rewards. So is there any example of that, or does that make any sense to you, perhaps, is the question?
Yeah, I think you're right, and I think you will be looking at jointly capitalized vehicles, because institutional investors tend to be, they like to deploy large amounts of capital. They don't really have the capacity to go into small and medium-sized projects, and so you're looking at jointly capitalized structures, and you're looking at structures which are standard legal structures. So you're looking at structures that are set up in financial sectors, in financial centers that institutional investors are familiar with. And there are a couple of examples. One very interesting example, I think, is India's National Investment and Infrastructure Fund, and they have it's a strategic investment fund. They have managed to mobilize capital, several billion dollars from Canadian and Australian pension funds, the Ontario Teachers Pension Plan and Australian Super Fund, as well as from a sovereign wealth fund from Temasek. And so here you have a structure where the Indian government owns 49%, so that the private investors have a majority in the fund, and also a majority in the ownership of the fund manager. So they have a fund manager where the Indian government has two representatives on a seven member board, and the others are the private investors. So I think it's the key is that you to get interest from institutional investors, you have to give them a significant measure of control. Another example is the Danish Climate Investment Fund. I'm not sure if I'm recalling the name correctly, but that was set up by the Danish development finance institutions and private sector institutions in Denmark, and it's also jointly capitalized. So I think you're right. I think you would have to look at establishing new structures which are set up under legal structures, and that investors are familiar with, and with forms of representation where they have majority and have control.
David, I believe you're on mute.
Thank you. I'm going to look at the questions coming from the audience, but while I'm doing that, one question I have that is based on a slide that struck me about the multipliers, and one that struck me as extremely high, and I was wondering what might explain that, or whether it's just a measurement error or something, is the Philippine Investment Alliance for Infrastructure. It's an intriguing name, and I know there's someone from the Philippines, I believe, maybe more than one on this call. What explains that high multiplier there? I guess that's a private-public multiplier, basically. Could you elaborate a bit on that? Is that a successful model or just an anomaly?
Multipliers are useful, but they're also a little bit of a blunt instrument. We use them because it's the best instrument that we have to calculate, to estimate private capital mobilization. But it also it doesn't say anything about additionality, right? So sometimes you can have a high multiplier, and the capital might not be additional to what would have been invested, without public capital involvement. The PNI, the Philippine structure, is managed by Macquarie, so it's a structure that's very close to, that it's itself very close to the private sector. It's managed by a private manager. So there's also the question of how much Greenfield do you do and how much Brownfield do you do. If you do Brownfield, your multiplier is likely to be higher, and your additionality is likely to be somewhat lower. So PNI does a fair bit of Brownfield, which explains to some extent their multiplier. I'd like to revert to the India fund, where they have been establishing a Greenfield sub-fund to provide pipeline for the master fund. So the sub-fund, which they call the Strategic Investment Fund, does come with public capital from development finance providers. So it's a collaboration where development finance providers are already involved. So yeah, I think it differs from fund to fund what exactly those multipliers represent and how additional they are. But I think we can conclude that pretty much all green banks, certainly the ones of them that are close to private sector structures in the way they work, and strategic investment funds, they do mobilize more capital, and they do seem to have a good level of additionality in many cases, so I think we're on safe grounds by saying that it's a model that's very much worth looking at for a development finance institution.
Okay, thank you. I'm trying to reword this question here. What kind of conditions do you think are key for large capital partners, including institutional investors, to join partnerships in support of the achievement of the Sustainable Development Goals, particularly in developing countries? Obviously, you know what those are. Broadly, they include many things, including building sustainable, resilient infrastructure and so on. So that's the broad question. And I would like to add to that a question about Greenfield versus Brownfield, because in many of these emerging economies, I mean, India is a case where you have a lot of Brownfield already because you have a large industrial sector. But in some countries in Africa or other low-income countries in the world, you don't really have that much existing industry, and much of what we're talking about is going to be Greenfield. So, how do you address the need for capital to take those kinds of risks in a Greenfield environment, which may be higher, I suppose, than in a Brownfield environment to a degree? Or am I wrong?
You're absolutely right, and clearly for Brownfield, for Greenfield, you need more public capital. You need more risk mitigation, either at the fund level itself or at the project level. So in the case of FONSIS, the Senegalese Strategic Investment Fund, they have invested in renewable infrastructure in partnership with Meridian, the equity firm. And then they've gotten debt capital from Proparco. So it's clear that yeah, you need more public capital, but still, I mean, Meridian has been in there, and with private equity, I think it's a 40 to 60 equity debt structure, and so it's doable. But for institutional investors, you would need to do this at the fund level. You need to do the risk mitigation at the fund level, other than for very large infrastructure projects. And again, you need legal structures that you would probably need to set up things in places like, you know, any of the financial centers, with legal structures that they're familiar with, and with a significant amount of risk mitigation at the fund level.
Okay, great. Thank you. So thanks very much for that presentation, and I'd like to ask you to stay on, and now bring in the other panelists to maybe give their own reactions to and have some exchange with, and maybe you've listened into the other presentations and you have some thoughts. But let me start with Miss Ahmed, since she just turned on her camera, and maybe you heard her presentation. I don't know on ag results, but in any case, she may have some reflections, questions to ask you, or thoughts that you have provoked. So please, Ms. Ahmed.
I feel like I'm on the spot. Can you hear me well?
Yes. Mm-hmm.
Let's see. I mean, I found all the presentations very insightful. I appreciate the different aspects. We're looking at definitely different sectors. So I don't have many questions at the moment. I apologize. I turned it on and did not think I was going to be called on to that.
That's the price you pay. David's turned his on, so we'll pass it to David, and you might come back later after you've heard David. David, you want to jump in here? David Horan?
Sure, thanks. So yeah, all really fascinating presentations, and all dealing with very different aspects of an overall better partnership approach to international development. So particularly liked the idea of using prizes. That I studied I used to do research in R&D policy, and that seemed like an interesting instrument to use. To be part of a partnership policy framework. Just on the trying to find my notes here. Just on the collaborative platforms for bringing in institutional investors. So you were saying these platforms are just starting out. It's a new framework to try and bring in greater development finance. And how these are large investors, and they'll only come in if there's a strong degree of, they feel they have a strong degree of control over the situation. But I was just wondering, what could a country itself that was interested in bringing in these institutional investors, what could they do to try and attract these pension funds? Is there any way they could use, say, their diaspora networks to get these large investors on board, or have you thought any bit about that?
Yeah, diaspora networks are really important, and you see it. For example, in the Nigeria Sovereign Investment Authority, largely staffed by diaspora with a lot of experience from global financial centers, and they have an infrastructure fund as well. They have set up some very interesting structures to mitigate risk for local pension funds, and other strategic investment funds as well have staffed up with diaspora. So, I think there are probably several ways of using diaspora returnees to engage foreign capital and to engage institutional investor capital from the networks that they have. but you have to offer them, you have to offer them good terms. And I think strategic investment funds like the ones that India has set up, Senegal has set up and staffed it with their diaspora. Nigeria has another set up and staffed with diaspora. These are, and there are a number of others. In Europe, there's Ireland. France has one. So these structures seem to be good structures for engaging knowledgeable investment professionals from the diaspora, also because you're able to place these structures outside of the public sector pay scale, simply so that you can remunerate these people not in the same way that they would be in the private sector, but you can offer attractive terms.
Great.
I hope that answers your question.
Okay. We have a question from Sheldon Noel. Has there been any research on the impact of MDBs and DFIs on capital mobilization for small island developing states, particularly in the Caribbean? And secondly, well, this might be a little bit challenging, but we'll ask you anyway. Can you give any estimate of the financing needs for Latin American and Caribbean economies for green development? I guess you could say for what is the SDG financing gap for these countries? Big questions. I don't know if you can answer either of them, but maybe give a try.
So I would probably pass that one to someone, one of the other panelists.
Okay. Anybody else want to take a stab? David, you're on mute. Need to unmute.
I'm sorry, I didn't catch the end of the question. Could you just briefly summarize it so I hopefully...
Well, it's a question about capital mobilization by multilateral banks and finance institutions for small island developing states. And I guess you could extend that question to what extent they've accessed institutional investment along the lines of the presentation we just heard. But secondly, what is the size of the financing gap that these countries in Latin America and the Caribbean face with regard to green development?
I mean, they're tough questions. I'm not sure. Are there estimates available? There should be some type of. I know there was a report on SDG financing and costing for low-income countries, but I'm not sure it was done for the SIDS. But just to go back to the idea of bringing in the institutional investors, I find this pretty fascinating. Like, what would get them on board? Like, obviously they're risking, they're very concerned about, they don't want to take on too much risk, basically. So you have to guarantee them a certain amount of a return. And, what triggers their buttons, essentially? Is it a very well laid out national development plan? Is it, what could we do? What could a country do to garner their trust more? Like in the case of SIDS, I'm aware that there's an initiative to, so like there are obviously a different category of countries, but there's an initiative to understand better how vulnerable the different countries are and to use that kind of a more data-based approach to tell, well, where should the capital be channeled to? And that would be one way maybe to get institutional investors on board if they knew there was other sources of finance going in there. But I suppose what I'm trying to think of here is that, if you're an investor and you're just going in on one project and it's in an environment that, you're not guaranteed of your return, you're probably going to be quite risk averse. Whereas if you had a feeling, a sense that there was other projects being undertaken and you were contributing to an overall kind of package or portfolio, that would give you greater confidence to unlock, it might unlock that type of investment. So I'm really just wondering what triggers their buttons, what gets them going. Have you any insights on that, Albert?
Yeah, let me try and answer that. I lost you for a little while, but
sorry.
I heard the last part of your question. So I hope I answered what you're asking. I think what you see is like, you know, any investment manager, if you have a new team that hasn't got a track record yet, then it's harder, right? And once you have an established team and you have a track record, it's easier to get capital. So you know, in the beginning, you will probably need more public capital and then, you know, as the team gathers experience, as you get you get some projects up and running, you know, you will establish the confidence that you need in the markets. And I think, you know, that's what you see with the funds that already exist. If you look at again the India's National Infrastructure and Investment Fund, it took them a couple of years to get capital from the foreign pension funds when they needed to get things going, right? So there's that, and you know, another thing I think is these local partners, it's a good thing. Local, right? It's when you into it, it comes from domestic investors as well, but of local managers. So, you know, the boots on the ground on the one hand, and then being present on platforms on the other hand, on international platforms that exist and that they're out there, and pension funds are on them, but, you know, there are no development finance providers on there, and there are only a few strategic investment funds. Can you still hear me well?
Yeah, you're breaking up a little bit, but I think I caught most of what you're saying. Yeah, that's very interesting. Are you still there?
So we have a comment from Michelle Scobie.
I'm here. Yes, I'm not sure if you can hear me. I lost you again for a bit.
Right. So following up on that, Michelle Scobie, who's from a small island developing state, she says, how can private finance help small island developing states achieve the SDGs? Do any work on successful, sustainable small investments that are not just short projects? In other words, you know, basically the institutional investors, I guess, are looking for moving large chunks of money. They're not interested in small projects. That's why you have these funds, which provide diversification and aggregation. But are there any examples of such things happening in small island developing states? Or I guess, how do you scale down, or can you scale down investments? Is the best way to do that through these funds or other means to attract private capital into countries like the small island developing states?
If that question is to me, I think, you know, a challenge is to get enough diversification. You know, you need to be able to diversify your portfolio in a way, in one way or another, right? So the challenge is to have in small states and in small contexts in general, is to establish a structure where you have sufficient diversification opportunities. So you might need to look at structures that are supranational, that where the investment manager would be free essentially to look at opportunities across a number of nations within a certain region. I think if there are not sufficient opportunities for diversification, and you look at a very concentrated portfolio geographically and maybe also in terms of sectors, then it's going to be hard unless you have a lot of risk of public capital to provide risk mitigation.
Right. Any other questions? I think that was the last one. I think that Raymond Sané had a question, but I don't know if it was directed to you or to David. Hold on, let me just see. Okay. What is the average rate of return on investment for blended infrastructure investment projects? I don't know if you can answer that. In light of the gap in regard to SDG financing, can we expect that institutional and private equity funds could accept lower rates of return to help SDG implementation? That's a big question. I guess some of them, a very small percentage might, but is that a possibility for a larger share of private finance?
It's a lot of investment managers are hold their cards a little bit tight to the chest when it comes to their returns, but last time I was in touch with Ponsis, the Senegalese fund, their hurdle rate was 12%. So you get the hurdle rates. Sorry,
how much was the hurdle rate? Sorry,
12%.
12%. Okay.
Yeah. So you get the hurdle rates, and you don't necessarily get the returns on each investment. These are commercial investors, right? So, but you get the hurdle rates, which are in these can be in this area. When it comes to lower returns, I think pension funds have their fiscal their fiduciary duty, right? So it's and that's going to remain the case. They have a fiduciary duty to generate as much return as possible. Now, if you look at that can be done within a certain framework. Now there is the Net Zero Asset Owner Alliance, which has 33 members, funds. So and they have a net zero commitment by 2050. They have intermediate objectives to reduce emissions from their portfolios. So I think you will see more of that kind of commitments, and hopefully an increase in the sign to the Net Zero Asset Owner Alliance and the Net Zero Asset Manager Alliance as well, where you have where you operate as a commercial investor, but within a certain mandate or a certain framework or certain objectives.
Right. Okay, great. Do you last question, and then we're going to have to go to the sum up by my colleague Colm Foy. Do you think that these kind of self-imposed restrictions, like the net zero asset owners or investors, could potentially lead them to direct more funds to investments in some countries where those opportunities exist, and maybe at lower cost with a higher return? I'm thinking about nature-based solutions, for example, in developing countries with large natural assets. but also in infrastructure and other areas. Do you think that commitment to net zero might actually help direct funds more towards some emerging economies or not? Or is it kind of neutral with regard to that? Or even perverse?
Well, there is, yeah, I think you touch upon an important point, because reporting requirements have become much more onerous, right? When you include climate reporting. Excuse me. The companies that can do climate reporting in a proper way tend to be larger companies, or companies that have a certain level of capacity. So you could look at that could, there could be some detrimental effects in that sense, that some companies in the global south might not have to undertake the kind of data gathering and reporting that increasingly, that's probably not going to be an issue. It's a hard question to answer. It's I think it's all really risk based. If investors can be convinced that it's doable within the risk parameters, or if risk can be mitigated, then yeah, I mean, they will go where the opportunities are to reduce emissions from their portfolios, if they have that kinds of commitment. But I think you're still looking at the usual risk return trade-off, which there will have to be structures to mitigate that for emerging markets. And also, most institutional investors are not necessarily familiar with infrastructure, and many of them are not familiar with emerging markets. So you join those two together, and you need structures to make them comfortable with the risk, and the risk being taken properly care of.
Right. Okay, well, I'm going to pass it. Thank you very much. I think my main takeaway from your presentation is you have a lot of work to do in the coming couple of years to get all of this in order, so that institutional capital, investor capital, can be tapped into in a more sustainable and on a larger scale to support SDG implementation. And that's a tall order, but we all should be working towards that. But you have obviously some expertise that none of us have in this area, so we wish you well. So on that note, and thanking all of the panelists for your excellent contributions, I'm going to pass it now to Colm for a brief summary of today's proceedings. Colm.
Yeah, this is possibly the worst job anybody gets to do after a 2-hour session. I just have one thing. There was a question about financing by region. The OECD has a thing called the Sdg Financing Lab, and it is a very, very detailed database, really, of financing for the SDGs. So you might find the answer to your question there. Funnily enough, maybe we should have called this session Partnerships, because the running theme that's been through right from the beginning is actually all about partnership. David set the scene, talking about establishing basically an inventory of what partnerships we've got, how effective they are, and how to improve them, and to create a portfolio of effective partnerships towards sustainable development. And he took the case of Ireland, which was it's a classic case in the sense of takeoff and failure, and then retake off with another look. And then this adjustment to find the right portfolio is a fascinating concept, because it really places us back at the beginning of the equation, and we're having to find what exactly we need to put into the equation to make it work. Some of the answers were provided by other speakers. For example, Parasta Hamed spoke, literally came closer to the ground about the work that's been done by AgResults. And that work is very specific and very detailed, but it also has lessons for everybody else that's been speaking today in the kind of wider world, because ag results can actually show results. And what's interesting is the partnerships go all the way up the value chain. They don't just stay with one part of the value chain. They don't just handle distribution or farmers or whatever inputs. And of course, then the partnership goes beyond that into the relationship between ag results and the outside world and farmers and the agricultural sector in general. So another kind of partnership, and one that seems to work. Dan Platts, although not specifically talking about partnerships, introduced us to an extremely useful tool from the United Nations, which is backed by the international finance institutions, and is again a really vast partnership spanning the entire globe in order to provide the tools that governments are going to need if they're really going to implement the SDGs and we're going to reach the goals. And then finally, and I'm sorry that I have to go so quickly through this, Hovard's fascinating presentation again was all about partnerships and partnerships between the institutional investor, the local sustainable financing initiatives, and the international finance institutions, or the MFIs. And so we see that from Harvard's presentation, it's perfectly obvious that it is only with a coalition of financing partners that the SDGs have any hope of being reached. I mean, the figure that he gave, which I haven't got in my head at the moment, of the financing gap is truly terrifying. And moving from billions to trillions just isn't happening. And when you see that the gap has grown by 70% since the crisis, the COVID crisis, I mean, this is a horrifying statistic. So, but there's hope, because by giving us the information we need to encourage the sustainable investment funds, the green banks, the MFIs, across the infrastructure and the financial infrastructure system, there is hope that with such partnerships and relationships, we can find the money finally to reach the goals, or at least get as close as possible to them. That is my report. I hope it's comprehensive. Thank you all very, very much for your participation. I'm awfully pleased to see that David has daylight outside his window. It'll be several hours before I do. But thank you very much, and thank you for some fascinating interventions. Over to you, David, and over to you.
Yeah, Jean d'Aragon wants to come in here, but I want to just reiterate, that was excellent summing up, Com. Thank you. And I really think that partnerships was a cross-cutting theme, and the presentations were fascinating and complementary. So thanks to all of you again. Jean.
Yes, thank you, David. If you're finished, I would just want to thank you, all the participants, and the speakers. Do you have some reflections you want to make before I close, or you're done?
No. I certainly want to thank the participants who have stayed throughout this. That's really great, and I hope that it's been useful. And we certainly encourage you to continue sending the questions. Unfortunately, it can't be as interactive as we would like, but that's the way the world works at the moment.
Yes. So I'd like to thank also very much on behalf of your USD, all the speakers, Harvard Talent, and sorry, thank you very much to you. You fought against the technology, and thank you very much. That was very great to have you. And so also David Oran and Faristo Ahmed, and we're also lucky to have had our presentation from our colleague Daniel Platts. I want to thank the participants, the people who sent their comments also and questions. It was fantastic questions also, and I'd like to thank the moderator, David O'Connor, and as well as the rapporteur, Comfoy, and also the people who are behind the scenes. So also the staff of the UNOSD that made the interns and the staff who work behind the scene and they make to make the session and the whole forum success. So I'd like to also, I wish you all a good night, good afternoon, and good day to you all. And then I invite you for the next session tomorrow, same time. So please, you need to register. That's the technology asks us to do that, but you need to register for the next session tomorrow at the same time. So thank you very much, everyone, and see you tomorrow.
Okay, thanks. I thought you were going to invite us for tea and crumpets.
You can come. I mean, I have cake here if you want.
Okay, everybody. Good day, good night, and we'll see you tomorrow. Cheers. Thanks again.
Thank you.
Cheers. Bye.
Thanks, Sean. Thanks, David. And thanks, Colin, as well.
Yep. Thank you, David. Thank you, Rasta. Thank you. How about?
Bye.
Bye.
Thank you, David. Thanks, everyone.
Bye. Thanks, Com, Jean.
Bye.